All right, we're live. Hello, everyone. My name is Darol Ryan, and next to me is Kim Arthur. I'm the managing partner of Main Management. Kim is the CEO, CIO, and today we're joined by a very, very special guest, Ryan Detrick. Many of you know Ryan is a distinguished market strategist, probably one of the most distinguished currently. He's always on CNBC or Bloomberg, etc. He's the chief market strategist at the Carson Group. We have him here today because Main Management and Carson have recently gotten into a partnership together. We're doing a lot of business with a lot of their advisors, and we'd like to talk to Ryan today. So we've got a lot of cool questions and some cool topics. For those of you that don't know Main Management, we're an investment strategist based here in San Francisco. We've been around for almost 25 years. We've got about 30 people on the team. Over half of our team are actually partners, so they actually own equity in the firm. And we've been helping advisors for a few decades with models and ETFs. So without further ado, Kim, you want to get us started, and then I can take a few questions after that.
Yeah, awesome. Darol, thank you very much. Ryan, real pleasure to get to have you on the podcast with us. So thank you for your time. Thank you for the partnership. Really appreciate it. So I thought I wanted to, I'm going to throw out there, I'm not a ball stick guy, so anything that I throw out, know that it's coming from a guy that knows nothing about that. But we are coming from 49er territory, and I don't, I kind of want to break the ice a little bit about the 13-5 all-time record between your team and the 49ers. And, I'm sorry that we had Joe Montana in 1982 and 1989, yes, particularly 89 to spoil the party. But having said that, how are things looking for the Bengals for 2026?
Well, first off, thank you guys for the invite. We're gonna rip the Band-Aid off right away. Huh? Let's get into this. I don't know. I mean, I always say this is why God gave us Ohio State football, which is usually pretty good. I mean, I'm not saying we win it every year. We're usually pretty good because the Bengals just make you so mad. So literally, according to the odds makers, right? I mean, the Bengals are favored in 15 out of 17 games, which, listen, I would take, we're not allowed to, maybe take the under. I guess we'll just leave that there. I don't know. But the problem with the Bengals is they can score 32 points a game and they give up 33 points a game. I think Burrow in one season, just a couple seasons ago, lost like 5 games when they scored 30. And in Brady's entire career with the Patriots, might have had a couple when he left, but with the Patriots, he only had like once. All right. So it's all about defense. They went out and got some players on defense. We'll see. I hope, hopefully it works out. But should be fun either way. Yeah.
Good. Well, that'll be fun. We'll be watching for that.
And another thing you guys have in common is that both of your kids just graduated from high school and are both off to college.
Congratulations, Ryan. Where's your son going?
Well, it's actually my daughter.
Your daughter, sorry.
Sorry, no problem. She's going to Penn State University.
Wow.
She's a Nittany Lion. I was, again, as a tried and true Buckeye. It's like, I can deal with Penn State. There's certain schools like the one up north. We don't like that one, but I could put up with that. But that graduation party, we did it on Friday. I'm still recovering. That was stressful. How'd your guys' graduation party go?
So mine is coming up. It's Thursday, so I'm long 5 kids. This is my middle. It's my first boy. I've had 2 girls that have already gone up and out of college. So he's going to the University of Utah. He's a big skier. So when I saw him pulling out the map and looking at the 35-minute radius from campus to all the ski areas, I'm like, I think he's going to lock in on that one. But I will let you know. I'll send you a text on Friday morning to see if I'm still recovering.
I mean, you've done a few. So my wife, she said we got 2 more boys coming. She's like, okay, I've learned a few tricks what to do next time. And even then, it's stressful. So good luck to everybody. Congrats all the graduates, but also all the parents that are doing the parties. It was stressful. It was stressful. But anyway, I can live through bear markets. Bear markets are easy. A graduation party, that's a whole nother level, guys. A COVID 100-year pandemic shut the economy down. That was easy. Oh my goodness, a graduation party with 80 people at your house. That was terrible.
That's pressure. That's pressure. That's for sure. So I like, I love the fact that you're kind of guiding your firm's strategic investment decisions and the investment strategies. I like that you are a data whiz, and I love that. And we do a lot of analysis here, realizing that history doesn't repeat, but it definitely rhymes. And then I like another tagline that I read somewhere about you, because I'm a huge proponent of this, that you give data to the advisors to allow them to make informed decisions. And there was a guy who was very instrumental in my career very early on that used that exact same verbiage there, and it always has stuck with me because it's so powerful. It's so powerful, but so simple. So maybe you can talk a little bit about your history and how you kind of came to those things.
Yeah, good one here. So, I believe it was Churchill said, "The further back in the past we look, the further into the future we potentially can see."
Yeah.
So I've been in this industry since the late '90s. Got the bug down at Xavier University, bubble. Obviously, didn't know it at the time. I was day trading, doing stuff, making money, buying. I was on margin. I had no idea what I was doing. Then everything crashed and I lost it all. But I learned very quickly, okay, margin works both ways. And oh my goodness, there were people that made money on the way down. I had no idea. But you live and learn, right? And I was hooked. And that's what I've done every day for like 28 years now, give or take. And it's just it's a joy and an honor to get to wake up and what are yields doing, over in Japan? What's going on in Germany? Like right now, South Korea stock market just had an 8% down day, a 10% up day. I mean, all this crazy stuff. I love it. It's so much fun. But in my career, a couple different ways to take this. I really started leveraging social media, I guess. I guess it was called Twitter back in the day. Like I've been on Twitter X for a very long time. I have a lot of followers, but now, and not everyone could use social media back in the day. I was doing podcasts before they were called podcasts. I was doing videos before people had videos out. I mean, I was doing this stuff. I've had a face for radio for a long time. That's what I'm trying to explain here. But so I started doing media and TV and all this stuff in Cincinnati, a couple different shops early in my career. But what I learned was from how to tell a story. I didn't learn this. I learned over time, but the stories are what people want to hear. If you can show, hey, listen, that we've been through this before. We've seen something like this before. The last 5 times XYZ happened. Here's what happened next. Those were really popular on social media. And I just kind of found a lane there. Someone like Sam Stovall over at CFRA. Sam's a mentor. I've watched him and learned from him. And to be able to tell a story as you're doing it, because here's a little secret. I guess we're all friends now, right? I'm not the smartest person in the room. I know that. Like, I know that. But what I can do, or at least I think I can do, is I can talk to a room. I can use stories. I can explain what's happening. I can talk confidently about what we're doing. I can talk about how our 16-person investment management team or investment research team manages over $8 billion. I'm not a portfolio manager. I'm a strategist, meaning I draw the snowman, the big picture views. Know enough to be dangerous, though, about how we're managing the money. And it's an honor to get to do that. And then it's just my career's kind of going a couple different ways. But I've worked with financial advisors now for almost 10 years. And, if you told me 12 years ago you'd work with financial advisors and enjoy it, I never would have believed you. But it really is an honor to work with financial advisors and to work with their clients and to try to help them reach their long-term investment goals. At the end of the day, last thing on this, a research team, I think, does 2 things. We create content and we manage money. And I would put how the Carson Investment Research Team has done that, let's say the last 3 years or so, up against anyone, whether it be podcasts, videos, blogs, commentaries, all the stuff we do, along with managing real money that our financial advisors give us for their clients. We've done, knock on wood, we've done pretty well. We're going to continue to do that. I know you're only as good as what you've done lately, but it is a true honor to get to do that every single day.
I love that. Well, Darol and you, not only with the first and last names that you share, have 2 other very common themes. Darol, like you, traded his way through college, and that was during the .com period. And then on top of it, Darol, prior to 2019, his whole career was derivatives and institutions. He didn't know what an IAR was. And I think, too, that if he would have been told in 2018, hey, you're going to build a second career out of IARs, he would have been like, oh, what's. And now I've never seen a person that gets more excited than Darol every single morning, knowing that he gets to go out there and kind of help out these advisors and create solutions. So it's awesome. So one of the things we have here, Ryan, is we've got a sector rotation strategy. It's our flagship. And like it sounds like, we rotate from sectors in the S&P 500 to ones that we think have better risk rewards and are going to give a better risk-adjusted return. And I'm just curious, with all your strategy work right now, are there any favorite sectors that you have in this market as we are, we're going through a little mini correction here right now. Yeah. But anything that you kind of like in your crystal ball looking forward?
Yeah, get there in 1 second. It's interesting. My first job out of college was actually at an options newsletter. So for
Mm.
almost 10 years, I worked in derivatives and options and kind of the statistics. And that's where I got a lot of my background for, kind of the quantitative side of things. So it's interesting some of the paths we take to get to where we are here.
Yeah.
So right now, we have been overweight equities. We've been overweight equities for a very long time. We've said this would be a period of inflationary growth. We wrote that in our outlook almost 6 months ago now. We said we'd probably have 3 to 3.5% inflation this year, but we'd probably see a strong economy. One of our big themes is the labor market is really starting to improve. 2 months ago, we said the labor market looked pretty good. People looked at us like we had three eyes in our head. Now we've seen almost 500,000 jobs created the last 3 months. So what's that tell us? The economy we think is going to improve the second half of the year. We all know what technology's done. Technology's had, I literally saw this morning, the tech move the last 50 days was a 6 Sigma event in terms of how tech outperformed the other 11 sectors. 6 Sigma. For the math geeks out there, that's supposed to happen once every 4 million years. It happened a couple weeks ago. So welcome to finance, kids. This stuff happens way. Those fat tails happen way more than they're supposed to. But that tells us, hey, tech's had a heck of a run. We've been slightly overweight tech, yes, and we still are. We're not short-term traders, right? We're investors. So we've been expecting to have some pain on that tech trade. Semiconductors up 70% in 2 months, and now they're correcting. I mean, if a lot of these semiconductor stocks drop 30%, would that really be a shock? I don't think so. After the run they've had, you have to know that. So to get to your specific question, we don't see a recession. So we think you want to be in the cyclical areas, things like financials, things like industrials. Those are two groups we like a lot. Financials right now, look globally. I mean, banks all over Europe are doing really, really well. Banks in the U.S. doing well. Regional banks, at the time we're doing this, are hitting like multi-month highs, right? You wouldn't expect to see that necessarily if the economy was falling apart. Lifeblood of a bull market, rotation. So maybe tech hands off the baton for a month or two. That's fine. That's okay. That's perfectly normal. And I think it very well could go to areas like financials and industrial, some of those cyclical areas that can still lead. We can get more into this if you want, but those are kind of some big views we have right now.
Yeah, well, we share that overweight in industrials and financials.
Great.
We're pretty confident that the end of this month we'll get the CCAR stress tests that come out, and clearly they're overcapitalized, so they're going to get the thumb that they can go, the thumbs up that they can go out and continue buybacks at an accelerated pace, increase dividends. So with you 100% on that. We also have this mid-cap growth thematic strategy. And it kind of came about in 2020. Darol and I were kind of we were kind of spitballing and saying Kathy Woods obviously has her arc, but she keeps it extremely concentrated, and there seemed to be less of a kind of a disciplined valuation approach, which sometimes it works, sometimes it doesn't. And we tend to be a little more disciplined on the valuation, but realizing if you're going to do thematics, you're going to pay a lot more than you would for growth at a reasonable price. But the strategy has roughly 85 individual names under the cover, mid-cap growth, has a lot of robotics, has a lot of automation inside of it, has a lot of cybersecurity, AI infrastructure, power and grid, kind of all the things that are, that are in short supply are going to need more things going on. So we like how that is positioned. And I'm just curious, do you do much in the thematic space as you're looking out longer term for long-term trends that you see?
Yeah, we do. We have some strategic models, like the name would suggest. We're thinking maybe say 3 to 5 years, and some of those themes you just talked about are real, and it almost sounded kind of like a little bit like Kathy, something Kathy would have there. Maybe have a little more broadening out. One of the things I want to talk about along these lines, these themes, those names you just listed, that still make a lot of sense going forward. So I work with Sonu Varghese on our team. He's our chief. What is his title? I think it's chief macro strategist. I think, but so everyone knows Sonu. Sonu Varghese and I work very closely together. And Sona's been pointing out that if we're in a bubble, which I don't think we're in a bubble, I want to be very, very clear. Maybe some of those names got ahead of themselves. Okay, that's fine, but not a bubble. Look at prices, what's going on. Look at semiconductor chip prices. Look at all these prices we're seeing with the core PCE and different components out there. Prices are going higher, which you tend to see, in our opinion, at the end of a bubble, the price is going lower. What was happening in the 1990s? All these tech components, different things, telecom, all the stuff that we were building hand over fist to get ready for the internet and everything that eventually did happen, just kind of oversupplied it. Things got too cheap. That's not the case now. So we think, we're not in a bubble. And I know my friend Dan Ives, I'm sure you guys know Dan, he says it's like the third or fourth inning. Listen, I don't know about that one, but I think we're not anywhere near some type of a major structural peak, at least even in some of those growth names and those sectors you just mentioned. So those are themes we really like. Now, also one more. Um, We'll talk about gold for a second, because I know gold's getting beat up. I get it. Gold just crossed beneath its 200-day moving average right now. We have about a 3% allocation probably to gold in our models. We actually added gold March 30th of 2023, so it had a great run. Gold gained 60% last year, had a really good year the year before. It was up 28%, 29% at the end of January this year, and now gold has really, really struggled. So I think when you think about these longer-term themes, is gold peaking? Are commodities peaking? No, I think we're in I hate to say commodity super cycle because everybody else says it, but these things can last for a while. We are one of the very few places. If somebody else knows one, let me know. In 23, 24, and 25, we said gold and stocks are going to do well together. And even this year, I thought they would. I know gold struggled. We've been saying these things can go together, and commodities and stocks can do well together in a higher inflationary growth environment like we're in right now. So I think something that's beaten up like gold, and people are starting to sell and, it broke its 200-day, look how horrible it is. I'm not saying go all in, but we do have a little bit of allocation to gold here, and I think that still makes sense from that longer term point of view.
Yeah, one of the sectors, the many sectors we're in, are these minerals, these precious metals that
Yep.
are used for technology, actually. And there's a bunch of companies that do it. So, that's been performing very well this year. And again, it's some of these mid cap growth, thematic themes. You've got to be a long term holder because there is volatility. So you've got to kind of know your audience for a lot of these things. But the nice thing is, I think so many people are concentrated in Mag 7. And in these type of things, there are no Mag 7. So I think a lot of people don't have that exposure, and they may need to check on it. So switching gears, Ryan, and this is kind of a two-part question. So one of our fastest growing models is our buy right. It's a hedged equity. This has been very popular the last few years. It's got, sort of a 0.25 beta on the market, and it pays out a yield. I'm kind of a two-part question. I'm curious, are you seeing a lot of interest with that amongst advisors and their clients? And how does that relate to your view on rates? Because obviously a lot of these products, including ours, pays out a yield every month or yearly. So just kind of think about that alternative space from your standpoint.
Yeah, great one. So we have, let's see, I think we just cracked 60,000 families served at Carson. We also cracked $60 billion, so two
Congrats.
easy numbers to remember. And thank you. And we're 600 financial advisors, more than 600 financial advisors. I believe it's up to 44 states. So listen, I hear from a lot of them. I mean, so the short answer is yes. I mean, there's definitely a lot of need for, not a lot of need, but a lot of questions, a lot of demand for alternatives and different ways to, kind of get away from just stocks and bonds, right? And what have we seen? You mentioned 2022, and I'm sure that did very well then. I mean, what happened in 2022? We all get it. Stocks did terribly. Well, bonds had their worst year since George Washington was the president, right?
Yep.
If you had a bunch of energy, you did well, or managed futures. We've actually gone a little bit into managed futures this year, expecting those to do well. And those have done really well. Again, those commodities and those trends that we just talked about have done really well. And one of the other themes that we've had building on this, and Grant Engelbart on our team, he mentioned, he coined this maybe 18 months ago. When in doubt, diversify it out. Because everybody knows, 60% stocks, 40% bonds. And I know that's not what everyone uses, but that's kind of the tried and true that we talk about. Well, that 40% used to be bonds. No more. We say diversify your diversifiers. We've been saying for a while that we're in a higher inflationary world, probably higher rates world. At the start of this year, we didn't really, I mean, of course, there's always a chance, right? Lloyd Christmas should tell me there's a chance, but we didn't really expect to see the Fed to cut this year. We thought the Fed was going to start cutting. It probably means the economy is weakening. We didn't see that, right? So we've been saying, expect higher yields, expect bonds probably to struggle a little bit. Of course, there's a place for fixed income and people's portfolios in the right portfolio, but to have some of these other diversifiers in your diversified bucket, like the strategy you just talked about, or maybe a little bit of gold or some managed futures or some different types of commodities, some trend following things. I mean, maybe even crypto in the right person's portfolio who's willing to stomach a lot of volatility but has time. Those are some things that clearly can do a lot better, because I wouldn't be shocked at all if stocks had a really good second half of the year. We think that's probably still possible. We came into this year, we said S&P probably gained about 15% this year. Right. So, and honestly, we're working on a mid-year outlook. We might up that a little bit, not by a whole bunch, but a little bit. We think the second half of this year is still going to be good. One fun stat, I think, is The S&P 500 just gained 19.5% in 2 months. All right. That's like one of the greatest 2-month rallies you've ever seen. In history, it's only happened 7 other times. All right. You're talking off the lows in 75, off the lows in 82, 2009, 2020, 2025. There's a 91's in there, and maybe I missed one. But for the guts of it, you get the feeling of that's lows, market takes off. Those 7 other times, the stock market's been higher 6 months later and a year later, every single time. I get it. You could say it's a small sample size, but I still wouldn't want to ignore the strength we've seen these past 2 weeks, or I'm sorry, 2 months. These past 2 months, yeah, could give a little bit back, perfectly normal. But the upward bias in equities is still alive and well, in our opinion. And that other side of it, the diversifiers, don't be all in bonds, have a diversified bucket's how we're playing it.
Couldn't agree with you more.
Yeah.
You know, we say the same thing. We actually have a whole team here that helps create models for advisors all around the country, whether they're at a broker dealer or an RIA. We work very closely with your partner Grant. And when we talk to advisors, you know, the only free lunch in investing is diversification, right? So diversifying of asset classes, asset managers. So we're definitely aligned there. I appreciate that. I guess kind of maybe 1 or 2 more questions. I'll finish up mine and then hand it over to Kim. But just kind of curious how, you know, Carson's got an incredible story, incredible growth. Kim and I have been out to your home office in Omaha. Got to meet a lot of your partners. Very impressive place. You know, our ETFs and our company and your company have got a partnership together. I'm curious how you think about us and other competitors and how you work. You guys as a strategy team, as a research team, work with managers like us to provide the best solutions for your advisor base.
Yeah, well, yeah, that's I'm stepping on Grant's toes a little bit with this answer, but I'll do my best. Here's what I know, right? When I started with Carson almost 4 years ago, it's amazing. You know, time flies, you're having fun. As chief market strategist, I said I want to work somewhere that is empowering financial advisors, right? I don't want to be the research team or the research guy who says, "Hey, you have to use this. This is the way it is." I've worked at places that you talk down to, well, I didn't, but the places would talk down to financial advisors. They would talk down to clients. I want to talk next to you. I want to talk with you. So a thing that we have really done, and Grant has led this so much, and other people, but Grant, on having different things on our platform that our financial advisors can leverage and use. We have something called Carson House View Models. It's about $8 billion that I manage and Grant manages, and Sonu Varghese on our team and Barry Gilbert. So those are, like the name was just Carson House View. That's the stuff we're doing. But we have a lot of other really smart third-party managers and third-party options that people can use. By people, I mean financial advisors and their clients can use. Of course, we'd prefer that they use the Carson House Views. But hey, how about use Carson House Views a little bit here and use somebody else over here and use somebody else over here to be diversified in a way. But the opening up, one of the things about, I probably can say this, 4 or 5 years ago, Carson was considered to be rigid, at least the investment platform was very rigid. You know, the fees were this and this and this. You have to do this. This is the way it is, or there's the door, in essence. I mean, it wasn't quite that extreme, but that's the guts of it. We've really opened up our platform. We've really worked on the fees. We've done a lot of things to empower our financial advisors who are growing significantly faster than the industry average, lots of different ways with the performance we've done, with the communications that we've done. Hey, the market's not hurting, but listen, you might as well ride the tailwind when you have it. And then when you open up the platform, leveraging really smart people like yourselves to help our financial advisors are all part of what we're trying to do at Carson Group. And again, why we are growing, I think, as fast as we are. I mean, guys, every day I hear from financial advisors at other places want to learn more about us. Doesn't mean they want to come over, but they want to learn more about us. I mean, right before I came on, I was on Schwab Network a little bit ago. This morning I was on CNBC. I have a face for radio. What can I say? I mean, people like to hear what our team is up to. I have a really popular podcast. If I can promote this, Facts versus Feelings. I do it with Sonu every single week. Like, our voice is out there. And it's really neat being the research team, kind of being almost in a way, kind of the face of Carson, because so many people, you know, I didn't know who Carson was 5 or 6 years ago. It is what it is. I mean, they're big, yes, but we're bigger now. But a lot of people know who Carson is because of what our investment research team has done. That's something we don't take lightly, but it's something that we're really honored and take very, very seriously as stewards of assets.
Yeah. And I think it also resonates well because all the advisors and yourself, you call each other partners. We call each other partners here. So I think that's why our story is resonating pretty well with a lot of your advisors. And we look forward to a great couple of years.
Absolutely.
So, when are you coming out to visit us, Ryan? I think we're going to invite you to our 25th year anniversary conference next year. If you could make it, I'm going to have to give you the dates now because your schedule's so busy.
Well, give me the dates after this. I will say, so tomorrow I'm in my basement in Cincinnati, Ohio, right now, but I will go to Omaha tomorrow to a home office thing. We were in Chicago last week with our financial advisor. I go to New York City for a couple days a week after that. It can be tiring, but it's also a lot of fun. I mean, sometimes I have a love-hate relationship with travel. Like, oh, I have to go to New York. It's like, but New York's awesome. Like, I get to go on TV and run around and see friends and eat good food. Like, are you kidding me? This isn't so bad. Well, yeah, definitely let me know when that is. I'd be honored to come out west. Love coming out west, and hopefully it can work. Absolutely.
Great. Love it. So I've got two final questions for you, Ryan. One, you got anything on your summer reading list that kind of is a bookmark that you're excited or maybe you've started to read? And then second of all, is there anything, you talked about fat tail risk, but the one example you gave was a right-hand one. Any left-hand fat tail risk that you see over the next 7 months?
I'll start with the second one first here.
Yeah.
I guess call it risks, right? We're talking about risks.
Yep.
What if the economy really starts to improve, right? And what if the Fed should be putting the pump on the brakes a little bit? I mean, that's one that we're kicking around. Not necessarily it's our base case, but it's out there. I mean, just last week, the ISM data we got on what manufacturing and services, and everybody saw how strong that earnings season was. Profit margins keep going up, earnings keep going up. Things are getting better out there. I'm not saying they're perfect. But they're getting better. What if the Fed should pump the brakes a little bit? I mean, I'm not saying it's like this, but in 2021, things are kind of nuts. Everybody had money from the government. Crypto was going crazy. SPACs were going nuts. All this money, people making a lot of money, a lot of big IPOs, not big, but a lot of IPOs in general coming out. And then the market peaked. We had a vicious bear market. Obviously, the war, interest rates, the Fed, all that stuff happened in 22, but it wasn't good. You had to pay up a little bit. So could something like that be a brewing down the road? We'll see.
Yep.
I mean, one thing about Warsh, he was known as being a hawk before all this started. And he turned into a dove to get the job. And now it's like, well, what'll he do now? I mean, don't forget this, everyone. And I forget the exact numbers off the top of my head, but historically, markets tend to test a new Fed chairperson.
Yeah.
Actually, I do remember now. Like the last 10 Fed chairpersons, the first 3 months, the major peak to trough correction on the S&P 500 is like 14%. Now, not all of them do that. I want to be clear, but you can get a test of a Fed chairperson, and maybe it's going to come from yields, right? I mean, I think that's not saying we don't know. Yields keep trickling higher here. That could be the test that's going to happen to the potentially to Warsh here, and what's he going to do? We'll cross it when we get there. Now, the interesting thing about me with reading, I truly don't read a ton, but I listen to an incredible amount of podcasts. Like I almost learn through listening anymore. I mean, I love to listen to the founders podcast, learning about what people have done, how they've created their businesses, how they've done different things. Lots of financial podcasts, sports podcasts. So I kind of have I've got some driving coming up over the next couple of weeks doing some things. So I've got like a big list of podcasts saved that I'm excited to kind of dig into, like the longer form 2 and 3 hour podcasts. And I really, again, love like CEOs and founders, top businessmen and women throughout history. How do they do what they did? Everything under the sun have happened before, but how does someone become successful to create what they did is the stuff that I'm truly fascinated by. And then, of course, hey, I like sports, so listen to some Bengals talk or Ohio State football. Or our Reds are terrible. They might not ever win a game again, but I don't listen to them. But this is fun stuff like that too is what I really enjoy to do.
Love it. Well, this has been a pleasure,
Yeah,
Ryan.
definitely, Ryan. Thank
Really
you.
appreciate it. We appreciate the partnership. And like you said, we'll get you the dates for the 2027 conference and see if your schedule has a hole in it that you can make it out. But you are definitely a man on the move. I love it. But what I also like too, you're like a homing pigeon. You always make it back to Ohio. And I understand now, like you said, you've got 4 or 5 generations of your family. So great place and great history, and really looking forward to more great things for our two firms.
No, I am as well. I mean, it's exciting to get to work together and continue to grow both of our companies, both of our firms, and just really help advisors, help their clients, and help our industry. It's one of the greatest industry. I think it's the greatest industry. Maybe someone could say healthcare. I mean, I wouldn't disagree, but I love to be in our industry. The things that we get to do, the way we get to help people reach their long-term investment goals, pay for college, pay for that second house, pay for this, pay for that. To continue to do that is something that's an honor, and I'm just glad we get to do it together now.
Great.
Thank you, Ryan.
Thanks
a lot, Ryan.
Appreciate it. Take
Appreciate
care.
it. Thanks.